Now we move on to the process by which a firm actually goes public. They start by filing an SEC statement. It's called a registration statement. It's also regarded as a preliminary prospectus. Being a preliminary prospectus, it means that they only have information that are basic. Some of the detailed information is missing. It's often called a red herring also. And then later on, after they have gone on a roadshow, shopped around their prospective selling of shares with various possible large institutional investors, they get some feedback, and then they're able to put together a final prospectus that will provide the final stock price at which they are going to sell whatever number of shares they're willing to sell at that point. So this is the cover page of a prospectus. Note some of the important things that are a necessary element of that prospectus. It first lists the total number of shares that they are intending to sell. It lists what is called their par value. This is kind of cosmetic, but it gets important when you look at this in the context of a balance sheet. Under the balance sheet, there are two numbers entered for common equity. One is called the book value or the common equity value, and the second is called paid-in capital. The book value of the 3 million shares is determined off that $0.001. So, or 0.1 cent. That will tell us the book value, and then the additional paid-in capital would be the actual price at which the stock gets sold to the market above that par value. So initially, in this case over here, Real Networks are valuing their IPO price at $12.50. They're expecting to raise 37.5 million shares, of which 2.6 million shares will go to the underwriting company in what is called underwriter's discount, or underwriters essentially fees. This is the fee that they're charging for providing their service to this company. So the net amount that they're raising is $34.875 million. Those are the important part of this document over here. So the underwriters work, as you saw in the Netscape video, the underwriters work with the company to come up with what would be an estimated stock price for that company. And this estimation is based on development of a cash flow, similar to what we did in valuation. We laid out the future cash flows, discounted those cash flows to the present, and came up with what would be the present value of those cash flows. That's one approach. The second approach that they often take is called the markets multiple approach. In a markets multiple approach, what they do is they look at the comparable price to earning ratios for peer group companies. Companies that are very similar to the company that is trying to raise capital. Then they average out those PEs, and then they use the average PE of the industry, multiply that with the earnings per share for the firm, and that gives them expected stock price. So this is, they take the key part over here is to understand that the PE ratio is average for the industry. However, the earnings per share is for the particular firm. So those are the two important distinctions that you need to keep in mind. Okay. So using the comparable approach, how do we value a issue? How do we value an IPO? In this case, we see over here that this company, Wagner, has a revenue of 325 million. And from that revenue, their earnings, total earnings or net income is $15 million. It has filed a registration statement with the SEC for its IPO. At what price should they price this IPO? So what do? They look at PE ratios. These are the PE ratios for comparable company. and they see that the industry average is about 21.2. Now, Wagner will have 20 million shares outstanding. So they will have 20 million shares outstanding. So based on their earnings of 15 million, so again the PE average for the industry is 21.2, and they will multiply this 21.2 with the earnings. You can either do it in earnings total or you can do it as earnings per share, whichever way. In this case, we get in total earnings. So we multiply the total earnings of 15 million with the average P/E ratio for the industry of 21.2, and we get 318 million as the total projected earnings for Wagner. Then we divide that 318 million with the 20 million shares. That's the number of shares that we have available for Wagner, and that gives us an IPO price of $15.90. We could have done the same thing. Instead of using PEs, we could have used price to revenue. Some multiple we have to use, either price to earnings or price to revenue. The average is 0.9. Wagner's revenue was 325 million, which means its average, if it behaved like the average firm in the industry, it would be projected to be like 292.5 million. And we get that by taking Wagner's earnings, multiplying that by the average. This is price to revenue average. And then we take 292.5, divide that by 20 million shares outstanding, we get 14.63. So we use two different methods, and that gives us kind of a range. Maybe between 14.63 and 15.90 would be the fair IPO price to set for this particular company. So again, to recap, two-step process. Number one, figure out the PE average or the price to revenue average for the industry, and then multiply it by either the earnings or, in this case, revenue, and then divide that by the number of shares outstanding to create those numbers on a per share basis. Okay, so you can review a very similar problem like this, how to use the comparables to calculate your initial public offering. Now, once that valuation is completed, then there are several ways in which the underwriter brings those stock to the public. One of those methods is to use what is called a firm commitment method. In a firm commitment method, the underwriter guarantees that it will sell all of the stock at the offer price. In essence, the underwriter is buying those shares at whatever, let's say it's 15.90. They're buying they're buying 20 million shares from Wagner at $15.90. They are now guaranteeing that money to Wagner. And then they're expecting to, of course, sell those shares to the public at a price slightly higher than 15.90. And whatever higher price they sell, that essentially becomes their spread or their profit. But they also have to work with what is called a lockup period. During a lockup period, they're not allowed to resell those shares to the public. Other IPO efforts include things like best efforts, where there is no guarantee. It does not. The key is it does not guarantee that the stock will be sold, but instead it simply says it will make its best effort. And then whatever they sell it at, they keep their underwriter's discount, and then they return the rest of the money to the firm. For well-known firms, they usually use the firm commitment method for IPO. For lesser known firms, they may have to rely on best efforts method because underwriter is unwilling to guarantee a price because of the riskiness of that company or less name recognition of the company. And finally, there is a method called the auction method, where the company solicits different auctions, essentially. They essentially allow people to bid how many shares they want to buy and at what price. Then they collect all of those bids and then they decide on one price that will allow them to sell out the entire offering. So let's take a look at the auction method, because that's probably the most interesting of the methods. Not as commonly used, but certainly the most interesting. In this case, what we have different bids coming in. One company has one business entity, could be a corporate investor, could be a pension investor, could be a banker, that they have said that they will buy 3.2 million shares at $16.50 per share. Another company said they will buy 750,000 shares at, or 75,000 shares at $19.50. So what do we do over here then? We take, and based on the bids that we have received, so here is an example. Let's use this as an example. So we have a company saying that they will buy 25,000 shares at $8. Another company says we'll buy 100,000, but we will only pay $7.75. And notice now, based on the bids, I have kind of ordered them from the highest bid to the lowest bid. Then what do? I go from the highest bid. I look at the number of shares that would be bought at that bid. Then I go to the next highest bid. But this time over here, I'm looking at cumulative demand, because it is 25,000 from the first bid to the 100,000 for the second bid. Then I go to the next one. The next bid was for 75,000 shares. So now the cumulative offering is 125 plus the 75, which is 200,000. And I keep on repeating it until I get to the end. And then I go back to my original problem, and I see that my goal in this company is to sell 500,000 shares. So at what price would 500,000 shares clear? And we see that the price at which 500,000 shares clear is $7. That means if I set the IPO price at $7, I will be able to sell all 500,000 shares. Because all of these other bids were higher, that means obviously they will buy those shares at $7. So that gives me the IPO price at which the auction IPO is cleared in the market. So at $7 per share, all of the shares will be sold. So $7 per share, 500,000 shares, that means I would be able to raise $3.5 million from this offering. Okay. Similarly, you can work on this problem. You, again, look at the numbers, look at the share price, order them from top to the bottom, set them up as cumulative demand, and based on the number of shares that you have to clear, you can see that the clearing price would be $18. So $18 becomes the IPO price, because over here we are looking at cumulative demand. This is the key part. Not the demand per share, but the cumulative demand for that stock price or higher. Okay. So you can work through that, and a similar one over here. A couple of similar examples that you can work off. So again, to recap, we have the firm commitment method, where underwriters purchase the entire issue at an agreed upon price and they sell it to investors at a higher price. We have the best effort method, where the underwriter is simply making a best effort. And then we have the auction method, where the underwriter is soliciting bids from investors and then choosing the highest price at which there is sufficient demand to, and this is the key part, sell the entire issue. All 500,000 shares, all 1 million shares that you're intending to sell to raise the requisite amount of capital. In the IPO market, there are several ununderstood phenomena. The first one that we encounter is called underpricing of IPOs. On average, we have seen from empirical studies that between 1980 and 2012, the IPO market, the stock after they went IPO, so the first instance, here is the company selling a block of IPOs. Let's say this is the firm commitment method, then they're selling this to the investment banker. Then the investment banker sells this to investors. What we have seen is that from here to here, this is the IPO price. Then from IPO to investors, this is the market price. This is the after-market price in the stock market. We see that on average, stock prices increased by 18% in that second leg. That means stock prices have increased by 18% on the first day of trading. Stated another way, this 18% represents underpricing. Meaning, you, the firm, sold the stock to the investment banker at less money than you could have received. And by how much? At about 18%. Why do companies leave so much money on the table? And by the way, you can see the underpricing phenomena across the different parts of the world. In some, and you can look at the US, the average US underpricing is somewhere here, which is about a little bit less than 20%, about 18%. So there are many countries that have smaller underpricing phenomena and many countries that have larger underpricing phenomena. We are kind of in the middle of the pack. So what explains this underpricing? Why do people leave money on the table? There's no good explanation for it. But one possible explanation is that the investment banker is not willing to take risk. What kind of risk is the investment banker taking? The investment banker is selling these shares to the investors. If after they sell the shares to the investor, stock price goes down, the investment banker could be sued that they did not do their due diligence in selling a product in the market. Because immediately after they sold the product, the stock price of that product went down. So to protect themselves, they buy the stock from the firm at a discount, they negotiate the discount. In many cases, the investment banker does have a little bit of a higher upper hand in the negotiating process because the firm is new and does not have the market savvy. So they negotiate it at a discount to protect the riskiness that they're taking. That's one possible explanation. It's not a very good explanation, but one possible explanation. It is also, we see that in the IPO market, we have the hot and cold phenomenon. So during hot periods, you see multiple firms doing IPOs, and then during cold periods, we see almost no firm doing IPOs. That means that the number of IPOs is not solely driven by the demand for capital. There are other factors, market timing factors, other factors that come into play for IPO process. And you can see this hot and cold phenomena playing out over here, cyclical. IPOs are kind of cyclical industries that kind of go up and down over different periods of time. There is the cost of issuing IPO. The discount below the issue price, about 7%, is the discount that goes to the underwriter. This fee is large because this is not the only fee that the firm is paying. There are additional costs associated with underpricing. So when you take the 18% underpricing, the 7% fee that they're paying, you can easily see that issuing IPOs is not a very lucrative offer, lucrative from the company's perspective, because they are often taking 25% upfront hit in raising that capital. Which means that for every dollar that they're raising, they're actually only keeping 75 cents, approximately. 18% on the underpricing, 7% on the cost of issue, on average. So you can see that the cost of issuing an IPO varies depending upon the size. The smaller the amount of money, the amount of capital you're raising, the higher the amount of fees you're paying. And if you're raising a lot of money, then of course the fees that you pay is small. This is not just the absolute fee, but this is the percentage fee that you are paying from that issue. IPOs also perform very poorly in the long run. Compared to the rest of the stock market, we have empirical studies to show that even 3 to 5 years after they have been issued, the stock price of the IPOs lag the overall stock market. So on one hand you have underpricing, on the other hand you have underperformance, then the question becomes, why do firms still do an IPO? And the reason is, what alternative does the firm have in raising capital? Although now there are more and more firms that are beginning to think a little bit outside the box, and they're beginning to use private equity markets, which are essentially raising large amounts of capital through a consortium of very wealthy investors. That's one way to put it. And they're using that, so this way they're avoiding the scrutiny of the public market, but still getting reasonable access to capital. Not as much as they would have received if they went the IPO route, but not as little as they are receiving if they stick with only angel investor or venture capital. Sometimes a firm comes back to the market for a second round of financing after their IPO, and that's called an SEO. So this is when a firm that has already stocks that are trading in the market, they need additional capital, they come back to the equity markets to sell additional shares. And for a firm issuing an SEO, they have to follow pretty much the same steps that they did when they went into an IPO. The only thing that is not necessary is that the whole roadshow process and the price setting that they did with the roadshow process, that may not be necessary because the firm already has stock trading in the market. At what price would they do an SEO? The price at which the stock is already trading at the market. So instead of a red herring prospectus, they would do what is called a tombstone ad, and in the tombstone ad they disclose how many shares and at what price. And here are the investment bankers that are bringing the shares to the market, with the first investment banker whose name is listed being the lead underwriter. So in this case, the total amount of capital that is being raised is 4.6 million times 58. Whatever that number is the total amount of capital that this SEO is raising for real networks. So they did an IPO first, and then they did an SEO later. For seasoned equity offerings, there are two ways in which seasoned equity offerings are done. They are often done through cash offer, which is you just sell the shares and receive cash in exchange, but they can also be done through rights offering, where existing shareholders are given the right, not the obligation, given the right to buy the additional shares. So here is an example of raising money through rights offering. Your company has a market capitalization of $1 billion. That means that's the market value of the firm, which is the stock price multiplied by the number of shares outstanding. The firm has 100 million shares outstanding, which means the stock price has to be $10. So $10 per share, 100 million shares, that gives you a market valuation of $1 billion. Now you want to raise an additional 200 million, but you want to raise it through rights offering. which means each existing stockholder is sent one right for every share he or she owns. Okay, so one right per share. What you have not yet decided is that how many rights a shareholder will have to purchase one new stock. This is the key part. How many rights do you have to own to purchase one new stock? So there are a couple of options. You can either require four rights for one new share at a price of $8 per share, or 5 rights to purchase 2 new shares at a price of $5 per share. Which approach will raise more money? So let's take a look. So there are 100 million shares, which means with one right attached to it, there are 100 million rights out there. In the first case, you would need 4 rights to purchase one new share. That means 100 million rights divided by 4 rights tells you that you are essentially raising or issuing or you are essentially purchasing 25 million new shares. Essentially 25 million new shares have been issued at the market. At what price? At $8 per share. That means you have raised $200 million. That's one option. In the second option, it is 5 rights for 2 new shares. So now you have the 100 million rights that are out there, divided by 5, but with that you are getting 2 new shares. That means 40 million new shares are going to be purchased. At what price? At $5 per share. So $5 times 40 million is 200 million. That means both rights will raise the same amount of money. So you are indifferent between 4 rights leading to 1 new share at $8 per share, or 5 rights leading to 2 new shares at $5 per share. Both of these choices raise the same amount of $200 million for you. So you're indifferent between those 2 choices. So in both cases, the firm, after the issue, will be the 1 billion that it initially had, plus the 200 million that it now added. So the firm's value would be $1.2 billion. It had initially 100 million shares. It now has 25 million additional shares in the first case. So that means $1.2 billion at 125 million shares is $9.60. So this price exceeds the price of $8. So the shareholder will exercise their right because they're essentially buying the new shares at $8 per share when after the shares are issued, the value of the shares would be $9.60. So because of this, they're essentially getting a profit of 40 cents per right. So that becomes essentially the value of the right. So each shareholder is receiving one right valued at 40 cents per right. So either the shareholder can exercise that right to acquire additional shares, or they can simply sell those rights to somebody else at 40 cents per share. How do we get 40 cents? I take the new stock price divided by the right stock price, minus the right stock price, divided by the number of rights, and that gives me 40 cents per share. So the total value per share to each shareholder is $9.60, that's the new share price, plus the 40 cents, which is the rights price. So the new stock price is $100. Not the new stock price, the total value per shareholder is now, per shareholder per share is now $10. In the second case, what happens? Same $1.25 billion is the market capitalization of the firm, but now there are 140 million shares outstanding. So the new share price would be 857. Now, it's going to be 857 minus 5, which is the share offering price, divided by the number of rights, but I have to multiply that by 2 because each right gets of a total of 5 rights get converted into 2 shares. So that plus 857. So this part would be 143. So that 143 plus the 857 gives you $10. That's in both cases, the same amount of money is raised and the shareholders are equally well off. So they would be indifferent between the two choices. So you can work on a similar problem like this, work it out on your own. And another problem that is very similar. The final point over here, what happens to a stock price after an SEO? Because for an SEO, the stock price does go up a little bit. So overall, the return to shareholders also goes up right after. So this is the 0, this is the baseline. This is the day on which it is offered. So we see initially a run-up before the SEO offering. It dips down slightly, but kind of stays around that number. So there is a positive price reaction to a seasoned equity offering. So that completes chapter. This completes chapter 14.